Happy Friday, team. Technically, it's Thursday right now, but I'm doing this so late in the day that I won't get it out until tomorrow. So, TGIF, happy Friday. Hope everyone's had a warm week. I know that's certainly not the case now and won't be this weekend, but nonetheless, hope everybody's safe and their pipes didn't bust and we learned some lessons from Snowmageddon a couple of years back. So, here we go, team. Here's this week's good stuff. By the way, the background, you like this? Yeah, that's not a wooden wall. That's just a piece of paper. New office, waiting for stuff to show up. It's at least there, so it's not solid white and behind me. So there you go. All right, team, let's talk the good stuff. Let's talk about what's going on. Rates, still nice sixes, kicking up just a touch, right? See the 6.89. You can see the chart. Remember, guys, red is bad. Don't love that we broke the 25-day moving average. It's okay. Look at the 50-day average, the black line coming underneath it. Hopefully, we might see rates inch a little higher here in the next couple of days, but hopefully that 50 days is going to hold us. And again, right underneath that big blue line, that really long one, that's a 200-day. That's a really good indicator. So I'm very pleased. Again, we might lose a little ground coming up, and we'll see what the future brings. But here's what I do think the future will bring. You guys can see this is the Fed fund rates. When people say the Fed moved rates, you see the chart here on the right. You can see what it's been. Look at the 1980s. Holy smokes. But you can see on the far right side, the steep increase, right? In just the span of 16 months, so not even a year and a half, they moved it from 0 to above 5%, 5.5, whatever it is. So the yellow is what's projected. Here's the thing: markets predicting supposedly, up to 6 cuts. I don't know if that's going to happen next year. So we'll see. Time will tell. Inflation will come. But let's talk about this. So I had a realtor ask me, "Hey, do you have anything that shows like their homeowner who's being stubborn, waiting for a market crash?" Send this one. So at the very bottom, you guys can maybe see in black where the articles come from. So you guys can Google them or use this to at least find it. Go directly to the URL if you want to type it all in. But we've been saying it, and this is just one example of how it just came out on January 16th from Business Insider. That basically, before the home prices are forecasted to continue to rise, they're already at all-time highs, continue to rise next year. They say that because these lower rates are going to spur more people. Obviously, supply and demand kicks in. There's still a housing shortage. It sounds like I'm a broken robot or a broken record. Since over. But again, here's a great article. You guys can show this. Prices jumped 7%. So think about that, right? That means their $500,000 home. I don't know what 7% is, but call it 540-ish, give or take, probably somewhere in there. So again, if there's real equity to be made on buying a house today, don't wait. This was from the Wall Street Journal. I just thought this was interesting in case you see it from a mortgage side. I'm just going to tell you, don't hold your breath. But supposedly, Fannie Mae is going to look for alternatives to allow mortgages to close with just what's called an opinion letter, attorney opinion letter, instead of doing like the title policy. We all know the title policies can be very expensive. It's probably one of the biggest, it is the biggest portion, at least in Texas, that is, of closing costs. I would not expect lenders anytime soon. We shall see, because again, lenders are very persnickety. They need to have absolute, complete guarantee that these loans get off their books, because if it don't, it will literally put a lender out of business if they do too many loans that are not sellable. So while you may see these headlines, I wouldn't expect this to come in anytime soon. I'm throwing it out there so you can at least hear it here first. And if we see any other developments, we will keep you posted. Dallas-Fort Worth, not so much what we want to be known number one for. So in the rankings, we are the highest from inflation. With all these cities, you can see this. So we had a 0.9 increase, but between Miami, San Diego, San Bernardino, all that stuff, like we are the most expensive from inflation. Not ideal, is what it is, but that's why things feel really expensive here in Dallas. This was a stupid, I hated the article, so I'm throwing it out here. Newsweek.com. They threw something about Americans are losing their homes. Foreclosures jumped. They skyrocketed. Whatever the title was, it was just dumb. The reality is they're like, oh, it jumped 10%. Guys, I don't think I put it in here. The amount of foreclosures was like 0.5% or up to 0.7 or something really dumb. And so the biggest thing in here, it was down. Look at the second bullet point, down 30% compared to 2019. So in other words, pre-COVID, when prices went absolutely bonkers, it's still down 30% from before COVID. Foreclosures are not happening right now because we've had such a huge run up in prices and equity, the appreciation over these last few years. Houses have gotten expensive. We know that. And that homeowners have equity, so they're not going to get foreclosed on. They will just sell the house and take their money and run if they can't make their payments. So it's just dumb. It's clickbait. You guys hear people saying, "Oh, they're waiting for the crash." show this to them how it's again pre-COVID levels. It's really low right now. On the other hand, credit card delinquencies, those are up. Credit card debt's all-time high, and it hit a new record, apparently. Credit card annual percentage rate, the APR, hit a new record of 20.7% last week. That is crazy. Beats previous record of 19% from 1991. Credit cards are really expensive, so if you guys, shameless plug here, if you know somebody with high credit card debt, they have all that equity we just talked about, do a cash out refi. Nobody wants to trade in the 3 or 4% interest rate they have on their mortgage, but guess what? If you wipe out at 20-something% on big debt, I'm willing to bet it's going to save you some cash. All right, guys, I actually forgot to do this. I was going to do this when I opened the thing. Yeah, apparently Gen Zers are doing this, meaning the young kids. You can see how in this picture this young girl's doing it, and it's because the parents didn't give their consent to put their image on social and whatever it is. So they're doing this to quote unquote protect themselves, but it's basically their image, and they're just saying, I refuse to be in this picture. You didn't get my consent to take it, and that's what they're doing. So if you see somebody doing this, cool. My kids will not be doing that. So there you go, team. Let's get social. As always, like, share, subscribe, do all that fun stuff. We look forward to hopefully hearing from you guys. We'll be around this weekend. It'll be chilly. Be here if you need us for anything. And then when you think mortgage, guys, as always, think mortgage.